Hi there, everybody. My name's Ifti, but you can call me Ifti. I thought I would make a video about one of the stocks I hold. It's over here, my portfolio, down here, Apple. I hold 4% of my investments on Etoro in Apple. And I thought I'd give you an accounting perspective of it. So I'm using, as I usually do, one of the best investment sites out there. It's called Stockopedia, a subscription model to that. So apologies for overwhelming you with so much information. I'm going to pick through it for you, so don't worry. In fact, they make a great job of helping us. So quality-wise, it's 94. So what does that mean? There are certain financial metrics that we accountants use to assess the quality of a company. Every company has to have submitted annual accounts, and in America, it's every quarter they have to give an earnings update. Everything is regulated, audited independently, and it's very difficult to manipulate the risk, manipulate the earnings. In fact, there's something called the M score, which I'm not going to go into it now, but an academic called Benish, he applied very strict financial criteria to see whether the earnings were being manipulated. In this case, it's very low chance of that happening. So in terms of quality, Apple comes up with 94 percentile, which means 94 out of 100 is excellent in terms of the quality of its financial accounts. And here's why. Return on capital employed basically means how well it's reinvesting the money it has. So 30% is really, really good. In fact, if we look here, it's actually dipped. It was 34% in 2015, dipped to 24%, 22%, went up to 28, stabilized next year, and then gone up again. Now, one of the reasons it may dip is because of heavy expenditure on capital. So they're building factories or spending a huge amount of money on a product. Their investment would be paid off in years to come. So Apple's a very good quality company. The other ratio I just wanted to bring up is operating margin. Now, operating margin, I think they've got it here, is the percentage of profit it's making at the operating level. So here they've got a good definition. It's a measure of how much income a company has left over after paying its operating costs, such as rent and salaries. Anything which is directly related to the product or the service which it produces. 24% is excellent. Other software companies have got higher, but the thing with Apple is it's 1.6 trillion pounds in terms of market cap. That's if you bought every single share at its current share price of 128. That's how much it would cost to purchase the entire company. In terms of value, it's 21, which isn't very good, but in the current climate for a tech company, it is good. The most important ratio for assessing value is something called a PE ratio, price to earnings ratio. Now, this is going to get a bit technical, but I'm going to pick through it for you. The PE ratio is the most widely used ratio, primary valuation ratio used by most equity investors. It is the price per share divided by the earnings per share. What that means is that more expensive, the higher the PE ratio, the more expensive it is. So compare that with another company. Let's take Google, for example, or Alphabet as it's called. Its PE ratio is 29. Compare that with another FANG company like Facebook. Its PE ratio is 26. Compare that with one more, let's say Netflix. Its PE ratio is 59, just under 59. You can see Netflix is very heavily priced, which is why the value score is 10. Let's go back to Apple. Now, Another ratio is its dividend yield. Now, Apple does give a dividend, quite controversial. A lot of tech companies don't give dividends. They decided that that wasn't the way forward for them. But they are sitting on huge cash piles. Apple could afford to give an even bigger amount. It's sitting on 90 billion and nearly 91 billion of cash. It's massive. Okay, so let's look at momentum. Right, momentum is based upon its price and its earning momentums, recommendation updates, earnings upgrades, and earnings surprise factors. It's how fast it's growing in terms of its share price. So let's take it back. Well, at the moment it's 128. If you take it back to here, it's 134 back in early September. So it's going down. In fact, it went down quite a wee bit to 107 even. But if you look over the years, I mean, let me show you this one. Look at this. Did nothing for years. 2007, iPhone is launched, starts growing from 5, and then it really starts steadily increasing. But it's not until, I guess, here in 2017, 2018, that it really started to take off. In fact, one of the biggest stockholders, one of the biggest shareholders of Apple is Berkshire Hathaway, which owns 5.5%. Now, Warren Buffett bought around, if I'm not mistaken, 30 billion in 2017. So he bought it 2017, around that time, and it's earned him over 100 billion in profit, well, his company anyway. I don't think anyone's made more from any single company than investing in Apple than Berkshire Hathaway did. Right, let's go on to other aspects of this company. Right, so what can we tell? Revenue. Now, interestingly enough, Apple revenue has pretty much stagnated. You can see the CAGR, which means compound annual growth rate. It's only 3%. For most tech companies, it's much, much higher. But given the size of Apple, the fact it's growing at all is amazing. Its operating profit has been declining in terms of the compound annual growth rate. Look at this. In 2015, it was 71 billion, and it went down to 60 billion in 2016. It's climbed back up to 70 billion in 2018. It's gone down again. But you know, whether you're making 60 billion or 70 billion profit, it's still an awful lot of money. The net profit, so minus further costs, the bottom line, as we call it, has been growing. Apple famously paid very little tax. Other ratios which I'd like to highlight, we've already looked at their cash flow. Dividend is been growing on a regular basis. The percentage has been growing 9, 10, 10%, 13%. This is a cash machine, and they are sharing some of the wealth in terms of dividends with their shareholders, which is very good to see. So overall, an excellent company, reasonably priced compared to other tech companies, although it is getting quite expensive, sitting on a huge cash pile. And one of the good things is that this is one of the very, very few companies, tech companies, that actually pays dividends. Looking at news, let's see what there is. Anything major here? Apple's to cut. Next patient. I was looking for something to do with the Apple car, which they had announced. It might not be in these news. Let's have a quick look on. They announced the Apple car. Here you go. The Apple electric car project, codenamed Titan, is an electric car project undergoing research and development by Apple. Apple has yet to openly discuss any of its self-driving research, with around 5,000 employees disclosing the project as of 2018. They've announced it now. They were meant to release it this year, and I think that this could be a big competitor to Tesla. So if you're holding Tesla shares, which I also am, by the way, Tesla's down here, say just under Apple, then it'd be interesting to see how that competition hots up. Okay, guys, so this was my, this is Ifti, just giving you an analysis of Apple from an accounting perspective. We see it from all sorts of different perspectives. I thought as a qualified accountant, I'd give you my perspective. Thank you very much for listening, and see you guys very soon.